The legendary Warren Buffett is arguably the best investor of all time. The Berkshire Hathaway chairman and CEO has managed to outperform the stock market since 1965, achieving an average return of 10 to 12% per year after taxes, while the S&P 500 has seen a 9.7% average annual return during the same period. His success has earned him the moniker of the Oracle of Omaha. In this video, we will go through the 7 key rules of investing which Warren Buffett follows religiously. The rules are relatively simple to understand, but are difficult to master as most people or the average investor are unable to consistently abide by the rules. Rule 1. Invest in people. According to Buffett, investing in people is crucial for achieving success in the stock market. He believes that the 3 key traits to look for in individuals and management teams include intelligence, initiative, and integrity. These traits are essential for making sound business decisions and achieving long-term success. Buffett advises investors to invest in businesses with a competent management team rather than just focusing on the financials of the company. He suggests that investors should pay attention to who is calling the shots and make sure they are competent and trustworthy individuals. Ultimately, you want to invest in a business that is run by capable and reliable people, as this will increase the chances of the business succeeding in the long term. Rule 2. Don't follow the herd. Buffett is a firm believer in not following the crowd. He believes investors should make their own decisions and not invest in stocks just because everyone else is doing so. Instead, they should focus on what is happening in the market and not what has happened previously. This will create an illusion that what happened previously will definitely happen again this time. While it might be the case, we never know what's going to happen in the future. We cannot comfortably say, last year we had a great year and generated 100% return. This year we will generate the same return, so let's borrow more money so our return can compound. Yes, it might generate the same return, but it might be in 2, 3, 4, or even 7 years. Rule 3. Buy wonderful business instead of sticker butts, as per Buffett's strategy. He believes that investors should focus on investing in high-quality businesses with strong competitive advantages. These type of businesses have a sustainable business model and strong market position, which makes them less risky and more likely to generate long-term returns. On the other hand, buying distressed companies or cigar butts may seem like a good investment opportunity, as they may have one last puff of value left. However, these type of companies are not sustainable in the long term and carry a higher risk. They may have reached their peak and may not be able to generate the same returns as a high-quality business. Therefore, it's important for investors to be mindful of the risks and not just focus on the potential short-term gains. Rule 4. Invest only in what you understand. He believes investors should only invest in what they understand. He recommends researching any company before investing, as well as understanding the wider industry and market trends. It is an old-fashioned way of thinking, but it definitely works for a reason. Having a knowledge about the business and market can give you an edge compared to others, as you might spot something before anyone else does. For example, if you see in the news that a major customer for a company you're investing in is going through some financial difficulties, you might want to reconsider your investment, as that might impact the trading performance of the company you're investing in and subsequently drive down the price. Rule 5. Taking advantage of opportunities. Buffett is well known for his belief that omission of not seizing those opportunities often results in much bigger losses than any gains made through commission. He has spoken extensively about how important it is to recognize and grasp prospects when they come around, as some of them may never present themselves again. He suggests that one should not be afraid to take risks, as great rewards often come with significant time, effort, and cost commitments. This also follows the 80-20 rule, whereby roughly 80% of the effects come from 20% of the causes. In this case, 80% of your overall returns might be generated by 20% of your overall investments. The basic idea behind the rule is that a small number of inputs or causes tend to produce the majority of the outputs or effects. It also serves as a reminder to focus on the most important things and to not waste time and resources on things that will not make a big difference. He believes that taking ownership and developing an understanding of important factors and conditions are key elements when discussing big chances in life. By taking ownership and understanding the opportunity, investors can make informed decisions and navigate the uncertain terrain ahead successfully. This approach helps investors to minimize the risks and maximize the potential rewards by having a clear understanding of the opportunity and the environment. This also follows the 80-20 rule. Rule 6. Sell when something intrinsic has changed. Do not sell when the prices look too high. Unless you're short on cash and there are other opportunities that arise, then you can start debating the pros and cons of exiting that investment. It is important to wait for something intrinsic in the business to change, such as major changes in the competitive landscape or market trends, or even the management of the company. Rule 7. Buy stocks below their intrinsic value. Intrinsic value refers to the inherent or true value of an asset, separate from its market value or price. It is a measure of the underlying value of a stock, bond, or commodity, and it is based on an assessment of the asset's fundamental qualities, such as its cash flow, earnings, growth prospects, and risk. Intrinsic value is determined through a process of fundamental analysis, which involves evaluating a company's financial statements, industry trends, and other relevant information. The goal of fundamental analysis is to estimate an asset's intrinsic value and compare it to its market value. If the intrinsic value is greater than the market value, the asset is considered undervalued and may be a good investment opportunity. If the intrinsic value is less than the market value, the asset is considered overvalued and may be a poor investment. Intrinsic value is one of the most important concepts in value investing, as over time, the market will recognize the intrinsic value of the asset and the market price will move closer to it. Therefore, his suggestion is that you buy stocks at the price below their intrinsic value to get the most out of an investment. Following the 7 rules above will set you up with success in investing. It is just a case of being diligent in following those rules. He also encourages investors to take an active role in managing their portfolios and to be patient with their investments. By following these principles, you can potentially achieve long-term success in your investments. Remember that investing is a marathon, not a sprint, and by being disciplined and consistent in your approach, you can also achieve your financial goals. If you found this video useful, please share it with your friends. Give it a like, subscribe to the channel for more stuff like this, and leave a comment as to what video you would like me to do next. Bye bye!